right, welcome back, guys. Welcome to another Stock Talk live stream. I'm Jesse, and Andrew should be showing up eventually. Apparently, he is stuck in traffic. So, how's it going? How's everybody doing? Yeah, it's had another fun earnings week. I didn't really honestly pay too much attention at all. We got what British Warren Buffett. You cannot see. You cannot see. You cannot see. Can we not see? Let's see. Let's see. Can you guys see my screen? Give me confirmation there. Give me confirmation when you guys get a minute. But today the plan is you can't see me. Okay. Let's see what we can see. Let me see here. Yeah, it's camera. Let's see. Let's change it. It's darkness. Darkness, my old friend. How about now? How about now? You guys got me now? Nope. No dice. What? Oh, that's horrible. And it's the camera, right? Jeez. Let's see here. Man, that sucks. Oh, me, no screen. Me, but no screen. Okay. Well, I bet you I just made this a lot worse. Oh, what a mess. What a mess, guys. Let's see here. Because I think I just wiped my video. You know what? This is just going to be a good good intro of technical difficulties until Andrew gets here. And we will get it squared away. So let's go here. Let's remove this. We're going to do this. We're going to go back. Froze. Andrew sabotage. Oh my gosh. See, you guys could just like say whatever you wanted to, and I would believe you. So let's see, share screen, window. Let's see here. Dun dun. Let's try that. How about now? My bitrate dying? No, that's not good. So I've got internet issues. I've got camera issues. I've got screen share issues. I've got all of the issues today. Apparently, I do need to drink a Monster. I've been a little tired today. We can see, guys. We did it. Success. Live stream over. Thank you very much. All right, so today we are going to be discussing Paylocity. We're going to be looking at Paycom, and we're going to be looking at Monster. Andrew might need a little bit to get through, but what are you guys interested in lately? What's been going on in the market that has been intriguing you? I think end phase collapsed, right? So yeah. End phase tanked really nicely and recovering a little bit, but oh man, 71% down on the year recently. They had a nice drop from 120 to like 76. So yeah, that one's been absolutely destroyed. And the scary thing about that one, we don't really know where it's going. Like it doesn't seem to be like any clear indication of when that cycle might end. So it could be a really, really rough couple quarters for Enphase, but Paylocity and Paycom, obviously they dropped a decent amount. Last week? Yeah. And Paylocity, that was the beautiful one. And we went down like 40% from 248 to I think it got into the 140s. Dr. Martens, more interesting than Crocs. Nothing is more interesting than Crocs. Crocs, man, Crocs opened at like $74 after earnings and just ripped it. Like, man, if you would have bought the open there, would have turned out to be good. Hindsight, 2020. Holding cash, yeah, I kind of agree. Just for me personally, my cash position isn't huge, so I am kind of interested in building that up a little bit. Do I have a Crocs update? Not really. Not really. I don't know. It seems like Hey Dude's kind of been like a buzzkill. So Hey Dude has remained kind of disappointing. But if management is able to get their distribution correct and kind of work on that brand, it could turn out to be pretty good. But 30% in cash, that would be a hefty cash allocation for sure. But the nice thing right now is like 8% interest, or not 8%. Geez, that would be crazy. 5% interest is not too shabby on the cash allocation. So it kind of makes holding cash a lot easier when you're getting 5%. Auto Trader. Interesting. I haven't looked at that one yet. Let's take a peek. Oh no. What is this? Ew. Let's not take a peek. Never mind. Let's not look at that. No, but Crocs kind of seemed I listened to the call, looked over the report. Hey Dude was kind of a disappointment. And then we had the narrative for management was kind of like, I don't know, it didn't seem too confident going into 2024. So it seemed like we had some uncertainty there as far as 2024 guidance with Crocs. So we'll just see how that one plays out. It'll be interesting to see what happens over like the holiday season with their sell through. But I mean, they're so cheap. Like they're so cheap. They're trading at like a net yield is 13% right now. EBIT is 16. Free cash flow. Oh my gosh. Like it's still one that, I mean, they could remain flat. They could just flatline fundamentally, not grow at all, and just devour their share count and get their debt back into control. So let's see if we look at their debt. What did they do? They paid down a little bit. Actually, no. Oh, whoa. Long-term liabilities actually increased. That's interesting. And this is updated. So yeah, their long-term debt actually increased a little bit, but their buyback amounts, I believe, started back up. So if we look at their buybacks, yeah, they had almost doubled the buyback amount as compared to their debt. So debt repayment was 90 million, buybacks was 150 million. So they are starting to ramp up those share repurchases again, which, I mean, that could be the story. That could be the story for Crocs, is where they essentially flatline on revenue. They don't really grow, but they maintain margins and they just buy back a lot of stock and pay off debt. If they're able to do that, then it's going to turn out more than fine for Crocs long term. So, but I think I still think the market's thinking that it's going to kind of be a cyclical play and they're going to pull back pretty drastically. But we'll see what happens. It's a pretty interesting one. So, but man, like, what's the PE on Crocs? I mean, I go by yield, right? So 13% yield, but is that like an 8 PE? It's got to be like an 8 PE. 7.77. Oh, 777 PE ratio. It's the perfect number. Obvious buy signal right there. No, just kidding. Disclaimer, none of this is financial advice. This is for entertainment purposes only. I'm not a financial advisor, have no professional qualifications in this field, nor do the guests that will hopefully pop on here in a couple minutes, hopefully. But so Crocs, I'm just gonna let it bake, see what happens. Paylocity and Paycom is the one that I'm really interested about. And then we also got Monster. Monster, I think, moved up on earnings, and I think they're around $55 right now. So what are they? Yeah, 55. What was their bottom? 47. Okay. Yeah, because it was getting into, I feel like it was getting into a more reasonable area, but still you had to project out a decent amount of growth for Monster, and you had to also project out like not multiple contraction. What am I saying? Like multiple maintenance for the valuation. And if you did that, then it would have been like all right. So like if we get into, let's see, if we get into like a quick and dirty valuation of Monster, maybe I should just wait for Andrew. Should I wait for Andrew? I feel like I should wait for Andrew. So because I think he wants to pitch this a little bit more. But yeah, I don't know, for Monster, it's one of those where we do not want 127% return. At a 15% KGAR and off of historical multiples, while assuming a decent amount of growth, which is kind of interesting because they've actually gone through margin contraction over the last like 5 years. You can see that their gross margins have actually contracted a little bit, and over the last like year and a half or so, their net margins, operating margins also contracted. Free cash flow yield kind of like, it looks like free cash flow kind of took a hit. So I'm wondering if they had more like one-time CapEx expenses for the free cash flow. But if we just go off of like historical multiples and give them like 13% growth, 14% growth, which they've done over the last 5 years, and maybe a little bit of multiple expansion, or not multiple expansion, but margin expansion, then we're kind of like, my point of interest is really between like probably 38 to 48 or so. That's kind of what I'm looking at for just a 15% KGAR. So if we increase that risk-free rate, we're looking at like 30 to $40 probably. But UK is really cheap. Yeah, it probably is. I don't know. I don't feel comfortable doing individual stocks in I don't know, in other exchanges, and ones that are primarily focused in like other countries. I don't know. I just maybe the US is a false safety blanket, but that's just, I don't know. That's what I feel comfortable with. So that's what I'm doing. But let's see, PCTY. Oh, shoot, I need to do that over here. So PCTY. Hey,
what's going on?
Welcome.
Yeah, sorry. I've been I live in an area where normally there's not any traffic, and we've had traffic last 3 days. It's been really weird.
No worries. I had technical issues, camera issues, screen share issues.
Wow.
So I just chatted with some people, and yeah, we we looked over a couple things, but yeah, man, it's been a fun couple weeks, man.
Dude, it's been exciting. That's why my name's earnings have me dead. Just looking like trying to look at everything. It's like I don't even know how
Yeah,
to cover everything. And then like KPL report this morning had really strong earnings, but like I haven't been able to dig into it. But and then you had like things like Paylocity and Paycom.
Yeah, it's weird. I've almost been ignoring them to an extent. I'm like, there's so much going on that I feel like I'm just like lost. Like, whatever. We'll see what happens. Been like slowly going over calls here and there, but like, man, I swear you could just look at it nonstop for like 2-3 weeks, and you still probably wouldn't be fully caught up.
It's almost like there's people that do that.
Yeah.
Like they do that as their full-time job,
Yeah.
Get this stuff all day, build models.
Oh my gosh, man.
Talk to management. And then
so
go ahead.
Was there anything this week that reported that had you really curious?
IWG did. And then there's some ad tech companies that report tomorrow, and FleetCor reports tomorrow. KKR was this morning. So there's still like a good chunk of companies that I'm like interested in. A lot of the smaller tech companies are like reporting this week and next week. They just take a little bit longer,
Yeah.
probably a little bit smaller compared to the accounting teams need a little more time to work out the numbers and all that. But
unless you're Tattooed Chef, then you just delay it.
then you just don't have one.
Yeah.
And but like it's really frustrating. Like one of the things I'll say is it's funny because for those that know, IWG they're a company that they just as a quick summary, half joking, but also basically, what it is in a quick summary is same industry as IWG, except that they're profitable, they're growing, and from what it looks like, they're going to benefit pretty massively from, WeWork, or IWG is the same thing as WeWork. They're going to benefit from WeWork going down. The thing they always complain about is people don't understand our business, and then they don't even like put their trading update calls on the website. And I'm like, well, maybe you should like work on your investor relations website so it's easier to access. But I mean, I'm sure that like Wall Street and all those guys, they have actual like through Bloomberg or something, you're able to grab it. But
are they on the? What exchange are they on? Is it London?
London.
Okay. Yeah, I thought, and their ticker's IWG, right?
On the London exchange, yeah.
Okay. I thought I could grab them. Is it LON? And I think they've been looking at coming to U.S. exchanges, though, right?
Yeah, so
it's kind of been part of the thesis is that they'll eventually kind of.
Part of this trading update was they're saying that starting in Q1 of 24, they're reporting their earnings in dollars, in U.S. dollars.
And
then they're going to consider, instead of reporting in IFRS, reporting on US GAAP. And so
so they're setting up.
Yeah, they're setting up. And then they're like, we don't believe US investors understand our business, so we're having a US investor day in December. So they're actually going to be in New York doing an investor day in December. Basically, sounds like they're trying to start a bit of a roadshow to do the U.S. listing, whether that's NYSE or NASDAQ.
Yeah.
But either way, it's just a funny thing where they're like, and it's so different how like the UK stocks and companies, their reporting period and what they're required to disclose and all that. Like you get a trading update and you think it's like the same as a quarterly report, well, except that like the release is way less. The information you get's way less. But anyways, still trading super cheap. They're paying off like 25 million in debt a quarter, which is pretty good. So you're looking at just off that alone, they're doing at least 100 million a year in free cash flow. And I know they're doing more than that.
No, it's an interesting business model for sure. I've been interested in it, but I've been like, I don't know. I don't really know if I want to buy like the London shares, and then there's the OTC shares. I'm just like,
I would never buy it. I mean,
the liquidity on those is like nothing. Like you are the market.
It was exactly. It was something where like I was looking at for a while until I could figure out how to buy in the LSE. Like I was like, I want to buy that, but I can't. And I'm like, I can actually buy it. So, I bought it on the LSE, even though it's like you have to pay for the exchange and all that. And it's a much higher fee than if you're buying a regular US listed stock.
Yeah.
But yeah, they're going the right direction. Like their CapEx as because they're changing their business model. We don't need to get into it. That's not what this call's about, but really interesting business. And they did say that they're buying WeWork locations, which I think it's those might be corporate owned, which is kind of moving away from their business model.
I was gonna say like because they almost do lease like agreements, right?
It's almost like a
not
franchise,
directly.
Is how I think about it. It's like royalty agreements or management. You could call them almost like management contracts. Would be a good way. Like they're giving you the expertise and the network and all of that to get people butts in the seats at your office space, but they still have those corporate run locations. And I think if they can pick up distressed locations from WeWork filing, I think that's a solid move still, even if it's not exactly within the current go forward ideal, like the plan. But if you're able to just pick up 20 cents on the dollar for a location, you go for that.
Well, and I was gonna say too, the first thought that I had come to mind was because they're usually like really against that, and they like slam WeWork for basically like we knew this wasn't gonna work type thing.
Exactly.
So my thought is maybe they're trying to buy the distressed assets to get more of, I don't know, UX exposure, but then once they have them renovated or whatever for like their space, could they potentially sell those assets along with the long-term lease to an investor, recoup the capital, and then keep the long-term lease?
Yeah, I mean, they could for sure.
Yeah.
No, and like how they end up wanting to do it, I mean, that's totally up to them. But I think however you decide to do it, I think, and like they're saying, yeah, WeWork's, I think part of WeWork's issue wasn't just like the leases they had, it was also how they ran the locations, like the amount of, like you have to, like, I'm assuming that the leases that they're buying are cheap now, and they know how to run them. Like with a Regis, that has a lot better operating metrics than what WeWork did. And also, WeWork's biggest problem was like, I don't know if you ever watched a documentary on them, but it's like you go from your whole business is like burning money and taking on debt. So all of a sudden it's like, oh wait, the SoftBank capital is not coming anymore. What are we going to do? We were planning on another $4 billion coming in. Like, how do we fix this?
When your business is built on a house of cards.
Did you see the WeWork and I don't know what it was from. I don't know if it's like the bankruptcy plan. I think that's what it is. I'm like, because I'm guessing that they're going to go through it's a chapter 11. I'm guessing not chapter 7. The difference being chapter 7 means like basically you're closing down the business. It's never going to exist again. Chapter 11 is like, we're basically using all the current assets that we have and selling them off to pay off any current debt. And then afterwards will be like a new organization.
Restructure.
Yeah. I don't know if you saw the, I think that's what this is the, no, maybe this was just, here, I'm going to share this. And this is another guy that's like, I don't agree with his take that I'm going to put in the private chat that you can share it, but I don't agree with his take that IWG could potentially or should potentially buy WeWork. I would not want that at all. I think that's but I just thought the WeWork pro forma numbers are funny because they say the plan forecasts pro forma 2024 cash EBITDA. And I was like, what is cash EBITDA? Like, so
cash EBITDA.
Yeah.
Compared to Zimbabwe EBITDA.
Exactly. So, yeah.
It's interesting.
It's really, yeah. So
what did you think of Paylocity and Paycom reports? Okay. Let's get into that. Let's dive into it because I know we want to have some time for Monster as well. So.
Yeah, but let's hop into this. So a couple of things is I think for myself with Paylocity, I mean, easy to say this in retrospect, bought it about from today's price up. I think I was down like my average cost was somewhere in the high 190s, I think, or maybe like 193, 195, somewhere.
Okay.
Somewhere around there. I wasn't buying at the
That's not horrible.
No, but it's also not good. So,
yeah, I mean,
but I think in retrospect, one of the things was being, because I had said so I knew what the bear case was like, if employment slows down, if a recession comes, then you're going to hit a double whammy of lower interest rates and low growth.
Yep.
Now,
and high valuation, which means most likely re-rating, which is like almost a triple whammy. Like
right, exactly. Because and honestly, with Paylocity now, I don't really hate the valuation. I think it's not 23 times earnings, maybe 24. But the problem is
forward. I think
Yeah.
forward, something like that.
So here's the thing, though, is it all depends on what's your interest rate assumptions moving forward with this company. Now, we can talk the actual company's report. I mean, it was fine. They beat on just about every metric for sell side analysts. You would like to see. I mean, the thing is, sell side sets them up to beat expectations, but Paycom didn't do that. So I don't know. But they're growing fine in terms of headcount. One of the things they said was on the call was new wins and new customers were good, but current customers weren't adding employees, basically, which makes sense. So there's been a bit of a slowdown now. What some people think is, and just to kind of reiterate this, is that within the small to medium businesses and a lot of the B2B companies I'm looking at, like look at a Bill.com, look at who else? Toast today. A lot of these companies are just getting killed, which might
Toasted.
tell you. Yeah, they did get toasted, dude. Did you look at them?
No, I haven't.
I think they're down like 20% after hours.
Oh, really? Shit.
Robinhood got crushed.
Oh. Yeah.
Who was the other one that got killed today? There was another one that got killed today. I can't remember who it was. And Robinhood's another one, like the whole call, because Robinhood makes all their money right now with interest. That's where all their money comes from. And like their argument is, but when interest goes down, trading goes up, so it counteracts that. But I don't know, like we'll see how true that actually is.
Yeah.
And if you're losing market share, because like, the other one that got wrecked was Upstart. But like that's not surprising.
Oh, really?
Oh yeah, Upstart got killed too.
Yeah.
Yeah, this one going up never made sense to me. Like that whole thing never made sense to me. I was like, why is this thing going up?
Growth, my oath.
Yeah, but I don't know if they're having that much growth. But I mean, I guess maybe they're just so cheap at that point. I don't know. I don't really pay attention to them. So, anyways, to summarize, I think Paylocity is, as a company within this space, they're executing fine. They're hitting their goals. They're doing everything. The question is, how difficult is it to have a differentiated HCM, human capital management system? And what's going to happen to these companies if your growth slows down and interest rates die is basically the question. And so I think what people are starting to say is we're going to get, because let's say if you come to me and say, hey, Andrew, I looked into the future, interest rates are staying at 5.5% or 5.25% for another 2 years at least, then you feel a lot more confident. You're like, okay, this interest income is going to be really consistent and they can do stuff with it.
Yeah.
But like a lot of people are forecasting cuts to the interest rate, first one happening in like Q1 of 24. I don't know if that's going to happen or not, but now all of a sudden you have to model them losing interest income and gain. So how does that, like, what's their year-over-year growth going to look? Is it going to be basically flat for a year as those lumps from the interest income play out?
Yeah.
And so I think that's with them. I think Paycom had the same problem, except Paycom also has some.
Paycom has some special issues.
I'd say management or like execution. We'll say execution issues. I don't see execution issues from Paylocity. I'll put it like that. I do see execution issues from Paycom.
I think Paycom did a really bad job at getting KPIs together that could show insights into whether they're executing well or not during the transition. Because if they could have shown that, hey guys, we've got headwinds from losing a lot of revenue, but it's because we're so much more efficient. But look at these KPIs as far as our like retention, internal growth, and external growth of the customer base, like something like that. I feel like they could have like, assuming they're growing still, like they could have probably delivered it a bit better. So I'm like skeptical of how much of a headwind their internal, like the loss of those internal streams is versus just like how much is it just that they're slowing down?
Well, and you would think so. One of the things, and for those listening, the way these software companies work, generally, you get a client, they buy one or two of your modules, and then as they're your client longer and longer, they find or they tell you, "Hey, it would be really awesome to have this," and you kind of aggregate
Yeah,
what your customers
you
say, and
upsell.
then
Yeah,
you upsell. Exactly, it's land and expand is kind of the term. And what Paycom is saying is that they're basically not cross selling, not upselling anything except for their Betty product.
which,
So,
as I understand it, it's like this is the product that you can do everything with. Kinda, maybe.
no, it's because it's only for payroll. So, like, they still have other modules they can upsell you on. So, for
Okay.
example, for example, so Betty is just the payroll, right? It's the hours you put in. It's the employees, the time and labor management is one way to put it. That's what that is.
Yeah.
So, for example, Paycom has another really cool feature. It's not Betty. For those who know, I mean, I went through a whole process of with a bunch of these payroll companies, I think 5 or 6, trying to see which one was the best for us. And so Paycom had this one that's really cool where, so let's say I'm an employee, and Paylocity has something similar, although I think Paycom's is a bit better. But let's say I have a lot of employees that drive and they use their own vehicles, or we pay them on a depreciation expense,
Yep.
similar to like IRS. I can say I just hit the button saying I'm going to start driving now,
Yeah.
and it tracks the
It's a
miles.
geo track, right?
Yeah,
Like, yeah.
um,
I saw that as well. It's pretty interesting.
it's really cool because well. The thing that's really cool about it then is it's tied into the payroll so that it happens automatically. Your manager approves it, so then accounting or HR isn't having to like look at the expense management. And Paylocity is something very similar, but I think Paycom's is better incrementally for sure.
Okay.
The issues with Paycom is really they don't. Paycom definitely has an internal. I will say this: they have, and you could kind of feel it on the earnings call if you listen to it. 100%. This is the organization has an attitude or an internal feeling that we are better than everyone else. That is 100% their culture. Like I'll tell you that
Hmm.
right now. Like just dealing with their salespeople versus dealing with other salespeople for ADP, for Paylocity, for Paycor, for some smaller players. They definitely have like a we're better than everyone else. What's the word? Culture. Don't know how I feel about that. Like one of the things that I liked with the other guys, ADP to me just felt like, in some ways, ADP. It's almost like when you talk about like an old, like the old car manufacturers like Ford, Chevy, all those
Yeah.
guys. Like one of the problems of them versus a Tesla is Tesla doesn't have all this baggage of like all their old systems, all their old factories. ADP kind of feels like a Ford or a Chevy. It's like they have all these old systems, and like if you're trying to sell me on it, it just feels very like clunky and very I don't know, like not built for me, But anyways, Paycom. So here's the thing with these two companies. I think Paylocity is definitely in the short term executing better. They're going to see more growth. You're going to see better execution on Paylocity in the short term.
Yeah.
The question with Paycom is twofold, and I agree with you. They could have shown KPIs, and like a sell side analyst even asked, he said, "Why don't you show like your retention rates or like your NRR or your gross retention rates?" And they were like, "Oh yeah, we'll release it at some point."
Which, like, I don't know, man. That it's just fishy. Like, the only reason that you don't want to show KPIs is that either you're, I don't know, I was gonna say stupid and you don't have relevant KPIs already, or your KPIs aren't good. And like, I don't
Part
know.
of me wonders. So when it could have been this decel was faster than they anticipated, so they didn't think that they would need to explain themselves with these KPIs yet.
Yeah.
Like, so if you look at all these companies, they kind of said like this deceleration happened real quick.
Hmm.
Like And I was looking at something. Let me find it on Twitter. I hadn't heard this before, but what is this guy? Let me find it. Well, I'll be going through this and finding it. So let me see. There we go. I don't know if and I'll try to find it, but he was basically showing an index that like based on one metric, it looks like the economy really got hit hard, like for small and medium businesses in like June, July, which would explain like headcount, all that stuff fell off, a month or two later as they're responding to that. And Kale's just asking which Paycom or Paylocity has a founder that sells stock regularly. That's Paylocity. Their founder still holds probably 15%. If you look, he's slowly selling, which I don't blame him for. If I owned, I don't know, 2-3 billion at its peak, probably of how much stock he owned in that company, I'd be selling out of it too to diversify. But so anyways, yeah, I don't know if they just didn't have the KPIs ready because of how fast the decel happened, or if it's just doing poorly.
They had them ready. It's doing poorly. They didn't want to share them. Probably. Yeah.
So one of my things
could be.
So here's the thing: is if you think about this, and for those that don't understand what Betty is, I know Jesse's going through and showing kind of the page from Paycom that kind of explains it. But just imagine you're an employee, and instead of having to like go to HR and be like, "Hey, man, I missed a punch. I need to fix this." You just do it on your phone. Like everything's managed there. It sounds really small, but it actually can be a pretty big help in a lot of ways. Also, real easy to manage, like your 401k from your phone, a lot of other things. It's a cool app, and I when I looked at it, I thought it was really neat. The problem is one, this is really a product, I think, that's mostly for companies that have a lot of shift work, a lot of hourly workers.
Yeah.
So my company, for example, we have a lot of we're vast majority salary. So if you're majority salary, this isn't a great product for you because you're going to be paying more for a product that doesn't save you a lot of time. So
it's easier to manage with salary, and you don't have to really think of anything. All you have to really worry about is like time off, like vacation, like sick leave and stuff like that.
Exactly.
So it doesn't. Yeah, it's super simple. But if you are in a clock in, clock out situation, I've said this before, and I'm like, I can see why they can charge more, because if you need that functionality and you rely on that, then it's way more valuable to you than somebody that like is just a normal payroll.
Yeah, I don't know so here's the thing I want to, and curious on your thoughts on this. I completely disagree with how they rolled this out. So they want to make it like 100% everything's on Betty. I don't know why they didn't have a 2-tier system, because they basically cut themselves off from small, medium businesses. And they basically say that they went up market.
I would have. They kept their old product, but they aren't pushing it, right? Like, I think people that are grandfathered into it are still using it, right?
Correct.
So the only thing that I can think of is that maybe they took the stance that they're going to keep their customers on their old product. They're going to try to move upstream with Betty, and then eventually maybe they're able to roll out like a Betty Lite or something like that.
Right.
That maybe doesn't have as intensive like functionality, but they cannot offer it at like a way cheaper price point.
But also that to me doesn't even make that much sense, because basically that means you're doing more R&D just so you can make a product that's like hamstrung so that you can try to upsell them on the other product. And like,
but okay, so if it also depends though, because if they were getting like a ton of revenue from additional pay runs and fixes from timesheets and stuff like that, and that just disappears after, or let's say it gets cut by 80% after their customers move over to this, like that could be a pretty huge headwind. So maybe they had to potentially keep this pricier to make that not as drastic.
And in fairness to them, they had to do that because if you most of the systems now, like Paylocity, they don't charge you on a per payroll or per. It's just like you have this many employees, you have this many modules. This is how much you pay per month. It's a flat per employee per month, and that's what most of these companies. So they did have to get off that. It was a pretty crappy model in the way. Like it was a competitive disadvantage for sure to be on that other model. Tell me like, oh, I run it, and they're still on it, but their thing is saying like, yeah, we're still on it, but with Betty, you're not going to run that. I'm still kind of like,
So, and that it kind of makes me wonder, like, with that entire transition, you know, they revised down, obviously, but do you think going from a 20% growth rate to a 10 to 12% growth rate is really that big of a deal? Like, if they're going through a 1 to 2 year transition where this is going to be basically a pain in the butt.
Where does that growth rate go to though if interest rates drop?
Well, I mean, that's what they guided for.
Right. But what I'm saying is I think what analysts are looking at, it's the same thing with Paylocity. What they're doing is they're trying to say, okay, in steady state interest rates, these guys are going to get, like, at today's interest rates, they're going to have 10 to 12% growth. What happens if it goes down by like 2%? Now they're looking at,
I don't
like
think it's going to be that big of a headwind.
I don't either.
Because
I do think that's what
Paylocity
modeling.
Yeah, Paylocity actually has more in funds held for clients than Paycom, from what I've seen, and it looks like what. And so Paylocity is pulling in. If we extrapolate that over the year, they're pulling in about what 100 million a year.
Yeah.
Just in interest income revenue.
Right.
So like, and rates are at what, around 5% right now?
Yeah, 5.25.
Let's say that gets cut in half, and we go from 100 to 50. Right? It's a 50 million headwind. Now that's very profitable 50 million that you're getting cut, right? So then you're having probably further margin compression off of that because that's basically just free money.
Exactly.
But
that's a big.
If Paylocity is bringing in 100 or 100 or 25 per quarter, then Paycom's probably I think Paycom said they target about 80% of the Fed fund rate or something like that. That's like the rate they can usually get.
Velocities. I think they said they're at like 4.5-ish or 4.4. So that's
yeah. So they're probably sitting at about like 4.25 right now, both of them.
Yeah.
So maybe like worse, because I don't think rates aren't gonna go to zero in my mind. Like I think most likely we have maybe a moderation down to like 3%. I think if rates were to go to zero, something's really like the Fed's reacting to something, and there's bigger issues.
I mean, the Fed's dealing with the ramifications of going to a 0% interest rate right now. I don't think they're like, they've even said like we made mistakes on this. I don't think they're going to go back to that either. I think if you look at the grand,
I think they'll be more stubborn than anything. I think they might be overly stubborn to drop rates.
Go ahead. Well, I was going to say, okay, so if you look in the grand scheme of things, the last 10 years have been an anomaly in terms of interest rates. Like it makes more sense that they don't drop it if you look at historical rates, especially with just, assuming this is like, okay, you're just looking at like last few years. But it just doesn't make sense to me that they're going to drop it to like 0% again or 1%. Like, to me, 3 to 4% seems like a solid, steady state interest rate environment.
And I'm leaning right at that, like 3.5 as well. I think like worst case scenario, maybe they hit 2.5 or something like that. Like if they do an overreaction downward, maybe they hit 2.5. But I think they're going to be pretty stubborn on dropping them.
I mean, not only did they drop interest rates, the amount of, and not that we're trying to get to macro, but the amount of quantitative easing they did too, which also pushed down rates on everything. It was insane.
Yep.
I mean, dude, I locked in all my long-term loans at like a 2%, right? Except for the solar I have in my house, which I locked in at 1%. So like, it's like
I locked my 30-year mortgage at 2.5.
Yeah, exactly. You're like,
never getting rid of that thing.
Never. No, I was looking at this. I was like, dude, I'm never gonna sell this house. I could like rent it out, and like my cap rate would be awesome.
Yeah.
So, but
yeah. So let's say worst case scenario, it gets down to like 2.5 or something like that, or it gets cut in half. I think more realistically, I think the most probable thing that happens is that they probably go through a 20 to 30% headwind on just their interest income. So maybe that 100 mil gets cut to like 80 to 70 mil. Because I think we're most likely going to moderate down to like 3.5 or something like that.
I agree. I just think that what's happening is what this reaction is saying these guys have been profiting from interest going up. Interest isn't going up anymore. It's going to start going down. And what happens when interest rates? I'm not saying for complete transparency, like after these sell-offs, I think both companies actually look pretty enticing.
Yeah.
I'm just a bigger fan of Paylocity, but I think that's what's causing the sell-off.
Yeah.
Or caused the sell-off, I should say.
I personally would be more concerned with companies being strapped a little tighter, and therefore there's less they're less open to implementing a new HCM, right? So you have less churn through the industry, which could mean you have less growth in the better players because they're kind of just stalemating. They're slowing down. Not necessarily like a horrible like recession, but like anytime I would say that you have spend contraction in the economy, this could potentially be something that gets hit.
Oh yeah, for sure. Because people don't want to switch companies and go through implementation.
Yeah.
Implementation fees and switching costs when you're trying to figure out, wait, how can we make more? Like, it's more like, wait, yeah, like our HCM isn't great, but also like we need to make profits this quarter. So like, let's focus on something that could definitely be the case, especially in small, medium-sized companies where the focus of doing this also rests on the hat of the guy who's also in finance. Like the people that wear multiple hats. So it's like, I need to devote my time to making sure the company stays afloat rather than worrying about, this payroll system I don't really care for.
Yeah.
I do.
All right. Oh, go ahead.
I was gonna say, I think on a long-term macro, my thesis still stands that if you look at how many different players there are in the payroll, the HCM space, and the amount of people that still do it in-house, those in-house people are just going to keep on flipping it out because the tax code gets more and more complex. It's more and more of a headache to do. And I think you're going to still see tailwinds for a long time for these companies.
I agree. I think this is an industry that's going to have long-term tailwinds with maybe a short-term pullback headwind.
I think so.
If sentiment can get bad enough, then it could be a really nice opportunity. So, I mean, I think the first time we talked, like we ran through some numbers, and I was like, Paylocity around 150, I'd be interested, and Paycom around like 180 or something like that. Yeah. So they're definitely in way more attractive areas now.
Yeah.
And relatively speaking to other companies, they should have very, very stable revenue streams.
Mm-hmm. Oh yeah, I mean, the revenues, I don't think like you lose some headcount in a recession, but usually you're okay. And I mean, unless you went to like the GFC. One of the things I wanted to study at some point was look at the drop in ADP, because like they only dropped 30-40% at most in the GFC, which I know it sounds like a lot, but like when you're saying like all these companies get killed when the recession happens, it's not that bad.
Yeah.
And so I'm wondering if they were just a massive winner though at that time. That's when they're going through like their growth as to become the ADP they are today. I don't know.
I wonder what multiples they were trading at though.
That's what I'm saying. Like I don't know the story.
You know what I mean? Like I wonder if they were cheap in the first place, so there was a lot more support to buy them.
Yeah.
And they didn't really have to get hit with any type of multiple contraction or something like that.
That's true.
So that'd be very interesting. That'd be something to look at on like Ticker or something if you have that data for the last 20 years.
Yeah, I have to upgrade the Ticker. I thought I had gotten like the most expensive Ticker subscription when I got it, and then realized I like messed up and got the wrong one. And then I'm like, oh, now I have to like pay again. So I'm waiting for the subscription to end, which is actually coming up here really soon, to just upgrade it. But because I didn't want to like,
that'd be
it wouldn't just like roll me in to the new one. I would have to like pay the whole fee up front, like because I pay annually. So I think it ends actually end of this month, and so that's when I'm going to upgrade. But it's a really stupid. Anyways,
all right, Monster.
Completely different situation.
Let's sprint through this.
All right. So unfortunately, I mean, like I think if you know me, I was saying like this thing's a buy when it was selling off with all the staples, because I thought it was a complete overreaction and misunderstanding of the company. In my opinion, staples are selling off for like primarily two reasons. One is most staples have kind of anemic growth. Actually, I'll say three reasons. Anemic growth. There was a whole thing about like GLP-1s, like Ozempic, stuff like that was going to kill these guys. And then the other thing was most staples, consumer staples, have a lot of debt on their balance sheet.
Yeah.
And so, whereas Monster, first of all, no debt on the balance sheet, $3 billion in cash, I think. And I don't think people. So like, it's really interesting if you listen to. A lot of people talk about the bull case on like Celsius and stuff like that. Celsius is a competitor to Monster. They're like this new up and coming energy drink player in the space. I don't like the product at all. It seems like there's like two kinds of people. Either people like Monster or kind of other energy drinks like Monster, or you like Celsius. Like usually people don't. It doesn't have a lot of overlap. But what people say is like, if you look at it, the new drug, like it used to be tobacco, now it's caffeine. Like, it's the drug of the new generation. So anyways, Monster, I think people really are misunderstanding because I think it's got a lot of growth levers. It's still pulling. Like people look at this and go, it's been around for a while. It's been growing. Like how much more can it grow? And they had a really good Q3. So that's why it like rocketed up again. Where I was buying sub 50 pretty heavily, and now it's like I haven't touched it after the Q3 earnings. I think it had a good earnings, but I'm not in a rush to buy it. So basically, just so people understand, this company is also very litigious. They basically sued Bang into bankruptcy and then bought the asset after it went bankrupt.
That was crazy.
Yeah. And like,
what did they sue them for again?
False advertising.
Oh.
Yeah, because they said they had super creatine, but there's no such thing as super creatine. And and like they're saying because you were falsely advertising that, and they lost. I mean, Monster won the suit. They're basically saying like you were stealing people from our market, from buying our product because they thought that this was a healthy option and had all this stuff. And it really didn't. There were some other problems, but really what ended up happening, this is what I was telling people, was through all of this, because what happened was, it's really funny because Celsius also, by the way, that's the one that, so Monster, one of the things that's really big about it, that gives it a big moat, is they are on the Coca-Cola distribution network, and they're the exclusive energy drink that's on that. So anything Monster, which in Monster has a lot more brands people think. It's Monster, it's Reign, it's NOS, Full Throttle. Overseas, they have Burn.
And I think Coca-Cola has 20% ownership in Monster?
Yeah, that's what I was going to say, is that it's actually...
So, and that's another thing, like Coca-Cola is incentivized, right? Exactly. Like you can kind of, I don't know, the risk of them becoming a competitor is way less because for Coca-Cola, you would probably just rather boost Monster or take more of an ownership stake and ride that wave.
Also, like energy drinks are hard. Coke tried to make like Coke Energy, and just fell in its face. So it's easier to make because what happens, right, is if Coke has all these distribution networks and they get additional space with Monster, they make money on the distribution of that. So it's beneficial to Coke as well. And so like the question though is like, how do we know Coke isn't going to kneecap Monster? And it's like, well, you're probably going to see them start selling stock before they just want to just go in and kneecap them like that.
If Coke sells, we sell. No.
Yeah. I was like, oh no. So there's that. But like one of the things, so a little history on Bang and everything in Pepsi is first the Pepsi because basically the two big distribution networks you have are Pepsi and Coke throughout the world, really. And so Monster has always been Coke's big bet within energy. And Pepsi's tried a few different ones now. So first they were with Rockstar, and Rockstar just never took off for whatever reason. I mean, I don't really know why. I mean,
it had its moments, and then it just kind of fizzled off and died.
Yeah, really weird.
It was like...
Well, you know why it died? It's because basically what happened was Pepsi wanted to move on to a new... They didn't want to distribute Rockstar anymore because it wasn't doing that great. So they literally bought Rockstar so they didn't have to do... So that it could end the distribution agreement. That's what Pepsi did. Wow. So they like bought Rockstar so they could end distribution agreement.
It's cheaper to buy them and to like and kill it than to break their contract.
Yeah.
Oh my god.
Well, I mean, Rockstar's a lot smaller than Monster. Like it wouldn't be the same situation.
Yeah.
So then what Pepsi did was so they said, okay, so we're not betting on Rockstar anymore. We're betting on Bang. Yeah, Rockstar died because it was disgusting. I think they had some decent flavors. Like I think they had one or two okay flavors, but like to be fair, I don't like any of the original tasting like energy drinks. Monster, Red Bull, Rockstar, all those I think like the OG ones I think are gross.
I was mostly a Red Bull fan, but I've switched over to Monster lately. So
are you drinking like OG Monster or are you drinking like
mostly the like Ultra Zeros?
Yeah, okay, those are good.
Yeah.
I like those.
They're good. And they're like I like health wise, like I don't know, it's still probably crap for you, but it's like I don't know. It's a decent amount of B vitamins. It's not as bad as the OG one.
You know, you're like, at least you're not pumping 70 grams of sugar into my body along with all this stuff.
Yeah.
But
if I'm ever like really, really crashing, then I'll go for an OG one. But it's only when I need that special
I just
boost.
Never cared for the OG. Like even back when I was like in high school, there was like a yellow can and then I think there was a red one that was like a salt that was good. But I just never cared for like the OG.
Have you seen the like, gosh, they've got to be like 32 ounce like bottles of
BFCs?
those ones. And what?
BFCs?
Oh,
yeah. That's what you're talking about, right?
Yeah. And they got like the screw cap. I'm like, oh my God. Like, what are you doing?
They're literally called Monster BFCs. And I asked once, I was like, what does BFC mean? They're like big can. Like, oh, makes sense. Okay. I saw those. I had friends who would like drink those. I'm like, dude, you're gonna die.
Dude, I could not, man. That's crazy.
Oh yeah, no, it is. And but like the thing is, there's definitely a cult around Monster. Oh, I want to finish the Pepsi story because it's just I think something relevant. Because what happened was after they bought out Rockstar, they said, okay, Bang is going to be our new distribution bet. Basically, we're going to be Bang's partner. Well, through all like the bad PR, because there was other bad PR they had throughout this Bang did. They had their like founder did some weird stuff. I can't remember what exactly, but like just not good PR. And then there was a whole lawsuit with the false advertising. So Pepsi was kind of like, all right, we're done with the distribution there. So that's what killed Bang. That's why you stop seeing Bang anywhere. And Monster even said like, yeah, we think Bang's biggest problem is distribution. And it's funny because Monster is the one that caused the distribution to die. But now Pepsi's newest bet is Celsius, which the reason you've seen Celsius grow at insane rates recently is because they only inked that contract with Pepsi, I think, a year ago. And so they're just getting into all of Pepsi's distribution channels. In Celsius could be interesting. I just have a hard time. They're so expensive last I checked.
Yes.
Is that it?
They were crazy expensive.
It's CELH.
CELH? Okay. I think. They came down like what was it during 2022, like when everything was crashing pretty hard.
Yeah.
Oh gosh, yeah, man. They came down to like $40. And I was like, oh, this is not that bad. Like, I don't
To
know.
be fair, I think that was before they signed the deal with Pepsi.
Probably.
So like, because I bet you that
But
lineup you see at the end of 22 is when they signed the deal with Pepsi.
yeah, they already had like crazy growth going through like over the last 5 years.
Mhm.
And it was a nice pullback and like nothing had really changed, but it was still like quote unquote expensive. But it was like you're paying up, but you're paying up for something that could have like a really, really, really long runway.
Right. And they still could.
Which hindsight 2020, but it's still super expensive, man. Like it's super expensive.
That's what I'm saying. It's like I look at this now. What's the NTM? Do you have the like NTM estimate?
No, I don't.
Because
I
someone
don't
was
have
telling me like on a
forward.
forward basis, they're not expensive, but I still saw like Wall Street estimates were like $3 a share on NTM, which would still make it pretty freaking expensive.
So right here must be where they inked that deal, because they had a pullback going into
Is it Q4 of
2022?
Yeah, that's
And
right.
then it just freaking like
That's exactly when they did it.
rocket. Yeah.
Yeah.
Rocket ship.
And so like the thing about them is I'm always
and they went, oh shoot.
What?
That's crazy, because I'm just like, you look at their profitability after that too, right? And they just started like everything started falling into place. So what was their? Let's see. I'm just curious here. What was their margin? Yeah, look at that.
Yeah,
they inked that deal, and they went from like 8% operating margins to like 19.
Right.
Like, oh.
So that's the thing is, it's like, does that trend continue,
Mm-hmm.
or because the other thing too now is I don't know if they're getting it like because they're talking about international expansion. And by the way, even people
Monster
that are
is popular, pretty much everywhere.
Yes.
From what
The
I've
other
seen,
thing is,
like anywhere I go, like.
Well, the other thing is, from what I've seen, like it doesn't sound intuitive, but like the overlap between Monster and Celsius, like it's almost like they're not competing against each other. Like the people that buy Celsius wouldn't buy Monster anyways,
Yeah,
and vice versa. Like
I tried some Celsius, man. Like I tried multiple flavors, and I was just like, man, it just has this weird like taste. Like I don't know what it is. It's that sweetener that they use or something like that, but it just tastes like aspartame. Like I don't know what it is, but I just could not get with it, man.
Dude, I tried, like all my friends too, and they obviously, I mean, I wasn't even invested in Monster for the longest time. But I always made a joke, and I would like look at Celsius, and I was like, at some point, this thing tastes so bad, it's gonna die. I should just short it, like as a joke. I never did, thank God. But like, because I just think it's disgusting. But I think it's like different palates or something. Because I've heard people say like, "Oh, Celsius is the only one I think is good. All the other ones are disgusting." And so I think it just depends on your taste palate.
Well, and I don't know if you've noticed this, but and maybe it's just like anecdotal stuff I've seen, but it seems like the people that like Celsius are younger generation, potentially never tried Monster or other energy drinks.
That's possible for sure.
Because like I remember when I was getting into energy drinks, like I feel like there was a time where you're like, I don't know if I really like this. Like this is kind of bad, but like I need the energy. And then like your palate like comes accustomed to it, and then you're like, oh, and then you like crave it. I wonder if that's happening with like, I don't know, the younger people that are getting into energy drinks. That's what they're landing on just off of the initial hit, and then it carries through.
It could be. The thing is like, it's interesting because, for example, Monster is growing very rapidly. I mean, Monster grew almost 15% year over year, which you think like, I think this large and old wouldn't be growing that fast, but they are. And part of it is like rain. I know is a big growth spot for them.
Yeah.
And so with
alcohol.
Celsius, go ahead. What were you gonna say?
Oh, I was gonna say they have their Monster Beast alcohol line now. I don't know how that's doing, but
I mean, I just tried. I mean, anecdotally, I think it's interesting. So like one of the things it tastes, and it kind of makes sense. And I don't like OG Monster at all. It literally tastes like a Monster. Like one of them,
really,
it's a Monster that's 6% alcohol. That's what one of the flavors is.
what?
Yeah. Um.
Jeez.
So like if you're like a huge fan of like the OG taste, then you're gonna love it. And then you also don't have to worry about like killing yourself with caffeine. Um. But what was I say? The biggest thing, like, by the way, with Celsius that I'm just not um, bullish on is the big selling point by them. And like the big thing I've heard from people that are bullish is it's like branded as the healthier one, even though it's not really healthier. People think it's healthier.
Yeah.
And I think like Americans are more health centric now. And like I don't think Americans are ever going to be more health centric. I think that's like the same bull thesis I heard on Peloton.
Nah. Yeah.
And so, and the thing too is I feel like the setup is Monster. People know it's like not good for you. Like that's never Monster's brand is like, oh, we're the healthy. Like it's never been that. It's kind of been like,
Yeah.
X Games, kind of like living life dangerously. That's kind of been like their thing. And so I don't feel like there's as much brand risk there. I feel like with Celsius, like there could be some stuff that comes out and people are like, oh, this actually isn't good for you.
Yeah.
That could just like really hurt them moving forward. Now, like obviously I think that Celsius will be, if you're asking me, like I think Celsius will be fine. I think they'll grow. I think energy as a category is going to continue to grow.
Yeah.
And I think Monster continues to do well.
I was gonna ask you, do you have any idea what happened with their like margin contraction over that like 2-year period or so? Because
Yeah.
they were like super stable and then they just like drifted off and it looks like they're like resuming a recovery. Because I noticed their top line growth was pretty good, but their bottom line growth was like abysmal over the last like 5 years.
So there was like pretty significant issues from COVID with their supply chain. And it caused a lot of increased expenses for them.
Okay.
And then one of the things I do know, and I don't know, is that it shouldn't have a big impact in gross margins right now. Like you can see, it's recovering. Most of that is it's supply shock that happened. I know, like when aluminum prices went up and all these things, like a lot of stuff happened. I know that the alcohol segment has a little bit lower gross margins, but I don't think it's going to really be a major impact. And if it becomes a major impact, it's probably a good thing, which means their alcohol sales are really taking off.
Okay.
But it's mostly supply shock because you can see like when that really took a hit, the gross profit line was right during COVID, and that's really
they had top line growth and then their bottom line was actually decelerating.
Mm-hmm.
So it's probably just, you're saying most likely just commodity prices essentially. Well, commodity like aluminum,
commodity shipping,
yeah, okay.
A lot of those things. Like, if you listen,
that makes sense. Yeah.
If you really want to get a good insight into it, listen to the Q2 earnings from 2022. They really, because like go back to that chart. I think that's when like the gross profit bottomed, and so like the whole call was talking about that. I could be wrong. What is that? Is that Q2 22? Yeah.
Yeah, 630.
Yeah. Go listen because go listen to that call. And basically, the CEO said like margins are going to rebound from here, and kind of went pretty in depth as to why margins like had contracted that much. But that's why you're seeing like margin expansion now. So you're seeing like a top line growth, and you should be seeing margin expansion year over year as well. So like you're seeing like a pretty solid top and bottom line growth, as well as they bought like this distressed asset Bang that they're now like getting for pennies on the dollar and now getting to their distribution network.
Okay. Interesting. So, and that's kind of what I was originally modeling out was basically
their share repurchase program.
Yeah.
It's not amazing, but it's solid.
Okay. Yeah. So basically, what I was modeling out earlier was assuming revenue growth kept up at like 13%, but you saw like bottom line margins recover.
Mm-hmm.
So then you'd have bottom line growth probably around like I think I had it lower than this, but like 17% in the best case on bottom line growth. As we saw margin recovery. It could probably be a little bit better than that potentially. I don't know.
Potentially, but that seems somewhat optimistic to me. I would like, well,
I mean, that would be best case scenario.
Yeah.
Scenario 3 would be bottom line growth at 12%. So that would basically be maintaining margins with revenue at growth at like 12% or something like that.
Yeah.
Do you know what they're forecasting for? I mean, usually they don't give like more than 1 year of guidance, but
no, they don't give any kind of guidance really.
Nothing.
No.
Okay.
So those are always fun. It makes
so my first thought where I'm like, okay, how could this get cheap? Like how could this get really cheap? I'm like, if Celsius blows up and they have a bad quarter or a couple bad quarters where they see a huge contraction in growth, Celsius is blowing up and the market goes, oh wait, crap.
Yeah.
They could get hammered pretty quickly, and like I'm like, I don't know, I'm almost rooting for that to happen because I'm like, at that point I'm like, oh man, you could get into some very interesting price zones, because I think it still is priced for pretty good growth going forward.
It is. I think, like, I don't know if you can. What does this look like? Out of curiosity, like, put the price at like 48. What was it looking like? Like, can you do that? Can you like just input the price there?
I mean, that would have been a buy. That would have been a buy in my base scenario with a 15% target KGAR.
Yeah, because that's when I was like, this is insanity to me. Like, I would buy it here.
So with this, and that base case was only assuming 12% bottom line growth, which I think you could potentially get more if you get average growth on the top line, but you have margin expansion, you could get 15% bottom line growth over the next couple of years, potentially, which that would put you like a $60 buy, right? So it really just depends on like how quickly margins how quickly those margins recover at what rate, and then also at kind of their top line growth rate, what that ends up being over the next like 5 years, which I think they could still do probably 10-12% top line growth. That doesn't seem crazy to me.
No. I would think low teens growth is definitely possible. I think 11, 12, like, I don't see why they wouldn't hit that. I mean, just on pricing power alone, they'll be able to hit that almost.
Yeah. Because, okay, let's see.
Here's the thing also, that this is like the thing with these companies now. All these staple companies now, they're, for the most part, their expenses have flatlined. Now when they do these price increases, which they definitely could do, now you're seeing that all basically float to margins. Like before, it wasn't the case. But, and I think if you look at the cost of a Monster in the US, you're getting a Monster for like $2.80, $2.50 to somewhere between $2.50 and $3.
I buy them in bulk at Costco.
Yeah, okay.
It's like I think it's usually like $34 or something like that for 24 of them, and I'm like, okay. And then I like put that in the garage and just rock it. But you're right. They can be like probably 270 to 340 around me, just depending on the store.
And if they increase that price by 10 cents, no one's really going to bat an eye.
Yeah.
I'm not saying that, but my point is like, I think that I don't think they're going to do them, because they had a pretty big price increase at one point, and like the CEO there said, we saw zero impact to sales from this. He's like, no one cared that the price went up.
Yeah.
It had zero impact. So, because the other thing too is if you think about this, you compare this to a Starbucks drink, it's like Starbucks is like $6. I mean, so yeah, different target demographic probably,
Yeah.
but
It's easy to justify though.
yeah,
You can be like, if you're a Monster drinker, you're like, oh well, I'm just gonna go get a Monster instead of getting a $6-8 coffee or whatever. I
exactly.
go to Starbucks and like the specific drink that I want, because I'm like, I usually
Yeah.
get like a quad. I usually get like a quad shot, so like add a couple shots in there,
Yeah.
and it's like $7, $8 for a coffee.
Right.
I'm like, this is stupid. I get it like maybe once every 4 months now. Like,
Yeah, it's become like, because it used to be like you get your daily coffee and then once in a while you're like, oh, I'm getting my energy drink. This is like my, and now it's almost like, well, coffee's so damn expensive. I get an energy drink for half the cost,
yeah,
even less than that. Well,
yeah,
but me personally, I don't like, just for health reasons, drinking a lot of energy drinks. So I only have maybe one a week.
yeah.
But
Yeah, I think where I'm at with Monster is it really probably depends on your target KGAR. Because I'm going off of EBIT only, just because that seemed to be the best metric over time.
I don't know how
And
your model works, just out of curiosity. Does this
it's
look on a per share
interesting.
basis, or are you looking at just a company overall? Because the one thing I do want is you could factor in the buybacks, which should be between 1% to 2% a year.
So I factor in the buybacks.
Okay.
So dilution, you have basically you have the 5 scenarios here, right? And what
Okay.
you're each scenario is a hypothetical.
Okay.
Yeah, I don't know, run through.
Was that dilution
Right?
right there? The
Yep.
above.
Dilution. So if it's negative, your buybacks. Right?
Okay. Gotcha.
If
Gotcha.
it's positive, your dilution. And then you have your bottom line growth, and it just goes off bottom line. And I'll do manual adjustments if I need to. So right now I'm just doing EBIT only. So instead of doing like one based off of net income, EBIT, and free
Right.
cash flow, I'm just going off of the EBIT numbers. And then I'm not normalizing, so I'm just taking the latest data point to go off of the growth instead of the normalization.
Right. No,
so like scenario 1 essentially is like 0.82% buybacks, 10% bottom line growth with a future yield multiple of 4.85.
Okay.
If you go down to right here, so this is your EBIT yield. So you're basically, my scenario 1 is essentially saying that like we're gonna have like multiple contraction.
That's what I was gonna say.
Multiple contraction, slowing growth. Bottom line growth is only going to be 10%, and it's going to be valued at 4.85 multiple.
So,
but we still have a little bit of buybacks, and then off of that, the 5-year. I basically plot out the price based off of that growth, and then you have your 5-year. Oops, shoot, Control Z. You have your 5-year target would be 67. And then and then I run a formula to say if I want to get a target rate of 15% and I know my end number is going to be 67, what do I have to acquire the company at or acquire the stock out? And then that would be 31 or 33, right?
Well, yeah.
So it basically runs that 5 different times. And then I have like scenario spreads across the 5 ones. So
one of the things with Monster, and this is the thing is, I don't think there's any need to feel a rush to get into it. It seems like, and this is all companies really. It's funny, like the two companies I made the biggest mistakes on. Just as one is probably Paylocity. The other one was CrowdStrike. So CrowdStrike, like I bought at 130 at the time, it then dropped to like 110. And it was one of those things where like I felt a little like now in retrospect, you say, oh, you bought CrowdStrike at 130, nice. Because it's like 192. But the thing I realized is, it was like waiting for the right point. And I think you're in the Discord when I was like pounding the table in the 90s, saying like, you're insane not to buy now. Now, of course, I made the stupid decision to sell at 135, but then I bought back into it at like 150 because I was like, I think people don't understand the massive tailwinds in cybersecurity
Man, so the thing that I have the heart and I know stuff about this industry,
Yeah.
right? But it's almost like it's so segmented.
Right.
Like there's so many different niche areas that it's
Mhm.
really hard to like comprehend each area like really, really well and know who has the true advantages there.
For
But
sure.
yeah, in CrowdStrike in the 90s was intriguing. I feel like let's line this up. You know why? I'm gonna blame um I'm gonna blame Meta for any company that I didn't buy
Oh,
during this
that's
time.
fair. That's fair because you were probably buying Met at the same time.
Yeah, because like right there.
Yeah.
I think I was so distracted with Meta that
Yeah.
I was like ignoring so much other stuff.
Which is fair because yeah, I mean, because at the time, like the two things I was really buying was like CrowdStrike and Google, I think.
Yeah.
Um,
I during that time when a lot of these um tech players sold off, like the small cap, like the cybersecurity
mhm,
ones sold off, I was buying Meta, Google, and Amazon.
mhm.
That's basically all I was buying. I bought
Yeah,
those out.
which was, I mean,
And it
obviously
was
looks
just
like
it was like
great move.
I could have thrown some money at them here and there, and they were most likely going to be really really good long term. But it was
Mhm,
just it's hard to say no to those
right.
mega cap companies at the type of valuations we were seeing.
Oh yeah.
But
I mean, you did not make any. I mean, I don't think anyone can make an argument that buying Meta, Google, Amazon in like Q1 23 was a bad
yeah,
buy. It's
yeah,
impossible
it
to say.
was like, oh man. But no, like so going back to kind of what you were talking about, that kind
Oh,
of like translates into where you I've been very much so staggering into my allocations.
yes.
And I'm liking that more and more and more. And like essentially I'm at the point where I'm always trying to leave like when I'm buying, I'm already thinking about like how much more I can buy if it gets to like a lower level essentially. Like how am I going to ladder into that position if it gets into those areas where I'm like, "Oh, this is really really good. Like this is what I actually wanted."
And then like hugely stocks come to you. I think like all of us have like I don't want to say PTSD. I don't know what the right word is, but like 2021, it was like everything ran away. So you felt like, oh, if I don't buy it when it's like semi attractive, it's gonna run away from you. It was like the feeling that you had.
Yeah,
But
the
there's
time's
well,
on your side. Like
yeah,
just take a breath and like eh, I've been trying to just be like, okay, like this is where the price at's now. These are my ranges. Like, what allocation can I make this where I'm happy if it goes down? I'm happy if it goes up. I'm happy if it stays flat.
right.
Like, where is that sweet spot? And that's going to be different for everybody because we're all like psychologically going to handle those swings differently, especially with allocation percentages.
Yeah.
But that's what I've been trying to just figure out over the last like year. It's like,
It,
what's the sweet spot? And it's different
and
for every company.
if you don't mind, I'm going to share my screen real quick. I know
Yep,
we're
of course.
but just as a quick example, like here's, can you see the screen yet?
Yeah, I'm putting up. There you go.
So this is just Monster on like a PE basis. Like it's pretty obvious. Like you get these pullbacks. Like you can just see it. Like you get one here. That was probably like the
Yep.
temper tantrum. You got another one there. You had COVID. And this is where you had it like nothing pullback. And then you had this was Q2, I think, or this is Q1 22. Okay. Maybe that's when they first saw the decel. Um, and then, then we had this pullback again. So
Yep.
I mean, don't feel like you need to like, that's another thing that's always like a good gut check. Obviously, you should be looking at this company, understanding it and all that, but like also look at where you're buying it, like where its valuation is compared to historical norms is always a good gut check. Like, unless you have some reason you think the company's going to accelerate or grow in these forward numbers that sell side analysts, because like you should, like disclaimer, you should be able to tell people this is where I think they're going to go, and it may be different from this, but if they're trading at the top end of the valuation curve, why are you buying there? I guess would be the question. Or like, why do you think? Because there's been times where, you're buying at the top end. A great example is Nvidia, where everyone was buying it, and it ended up that it was actually cheaper than it appeared. So I think if you look at an Nvidia valuation chart,
and another great example of the reverse is Enphase.
Right. Oh yeah. I mean, just look in this Nvidia chart. This isn't the stock falling. This is the stock going up right here. Like
that's all the analyst revisions.
Exactly.
That's because that's your NTM right there, right?
Yeah.
So that's basically anytime Nvidia released earnings and analysts went, "Oh shit, we had it wrong."
Yeah, exactly.
And revised up. Right. Yeah. So, and that's the other thing. It's like, if you know a specific area really, really well, I really think the biggest opportunities are where you have the most knowledge and you potentially have differing views from analysts. And you're right. Right. Like,
yeah.
If you're an expert in an area and you're like, no, this is incorrect, like this is actually what's going to play out, and the market's seeing it differently, like that I feel like that's probably the definition of like high edge.
Right. And I think like in ad tech is something I don't want to say I'm an expert in, but I have a lot of insight into. And I think that people are underestimating how much ad verification is going to play a role in the future. Like these guys had insane earnings and just knocked it out of the park on their last ER. They've actually seen a bit of a pullback from there. But
I got my meta, I'm good, right? Like
so here's what I'll tell you what I've heard through the grapevine. I don't think I've told anyone this, is that let me stop sharing. Meta is very concerned right now with AppLovin, who does a lot of their AppLovin, their ticker is APP. They're concerned with them potentially doing what you call skimming. And this is what a lot of these ad verification companies, they do. They go in and verify, is there skimming happening? Are you getting the best bid? All this stuff. So just so you know, like this is a major black swan to AppLovin is if skimming is happening, you're going to see them crater again.
AppLovin?
Yeah. But like, I don't know if there is. Like, that's just, I know that Meta.
So basically, if AppLovin is skimming and Meta finds out and blocks that, then
they lose the Meta partnership.
Yeah. There goes their data points. There goes everything. Right.
And that's why IAS just signed an agreement with, or not just, but they signed an agreement with Meta to be running ad verification. They have they're with the Amazon DSP. They're on, which was like a big tailwind from. None of this would impact Meta's income really.
Yeah. Well, the crazy thing is that like Meta is still not that expensive.
No, I think a big tech is
it's not horrible. Like it's not crazy.
What's it at today?
Oh, this chart's all messed up, but
I mean, I have normalized forward earnings at 18.8.
Yeah, I mean they're trading on an LTM basis at an operating cash flow yield of like 7.8%.
Yeah.
It's not anything insane.
I
I would not be surprised if we see Meta making new all-time highs in the next year.
What's Meta's market cap?
Spreadsheet says 842 billion.
Oh wow. Okay, so
no, what's crazy? They got down to a market cap of like 220 billion.
Yeah, I was gonna say
crazy like that,
but never mind. I was gonna say, do they beat Tesla to a trillion valuation, which I think Tesla technically already hit a trillion at one point. But I mean, I don't.
No, the question is, do they beat Tesla to 10 trillion?
I forgot.
Gosh, man. Gosh. Yeah. Where is ratios metrics? Where is their enterprise value? Look at this.
Shit.
Look, their enterprise value, and this is just a quarterly snapshot, right? So at the lows, their enterprise value was in the 200 billions.
It's so funny because with these guys, I know why they sold off, and I told people like, it's so interesting how like the narrative got out there. It was actually really funny. I should talk about this is how I was telling people one of the reason I was buying Monster was they're getting thrown into the whole like narrative that Chamath was saying how like consumer staples are dead because of like Feastables and Prime. And I was like, okay, well, and Prime's already peaked. Prime's on a decline. But was gonna say no, and I told Fabio the concern with them was Apple was real. It felt like people were concerned that Apple kneecapped them, and there's no way back from that. So like at the time that was, and I was after I remember one of the earnings calls, I think it was Q3. I said it looks like they found out how to get around it.
Yeah, the Apple IDFA.
Yeah, and that was the big thing. And so but like the whole narrative was, oh well, they're capexing themselves because of is it Reality Labs?
Reality Labs.
They're like gonna send themselves into oblivion, spending like $1 trillion or $250 billion on this. And I was like,
I mean, it was a blessing because everybody was so stupid. I'm like, they're spending like 18% on Reality Labs, and they're going through a huge like capex cycle for these DC buildouts. And like the way that they get around IDFA is improving their like user logic and tracking, right? So like it's like this is so dumb. But yeah, man, the narrative around Apple IDFA was just horrible. No, absolutely horrible. And it got to the point where it's like, even if IDFA, like even if they can't track on the iPhone and they can just track like their user data internally or whatever, like the value of the ads that they present are still going to be worth a good amount.
Right.
Exactly. That's not it. You're just talking about like people are still going to want to advertise on Facebook because it's going like users are increasing, daily actives, monthly actives, everything was increasing. The platform was gaining more traction. And basically the argument was like, well, how effective are they going to be able to advertise? I'm like, I'll bet on them being able to figure that out.
Right. And I think,
like, come on.
And
especially at like, a P of 7 or whatever it was.
And the other thing that you're forgetting is I think out of all big tech, they're the ones that had the most balls to actually like lay off people.
Yes. Like, that was the bottom.
Yeah.
The bottom was them being like, hey, we're going to be, like drive efficiencies or something like that. They basically announced layoffs.
Year of efficiency. It was. It's funny because I bought Meta pretty close to when you guys did. I just sold a lot earlier because I was like, I'm not fully sold. I'm like, and obviously that was wrong with me. But the thing is, like, my biggest issue with Google has been I still think they could be more efficient. Like, from everything I hear and see about Google, it's not like they need to have the number of employees they do, but I still think that company is severely misunderstood, and which is wild for a company that big to be misunderstood. But I don't think people get YouTube. I don't think people get where their investments into AI are going. And so I'm still super bullish on them. And
I like
nice stock buyback too.
YouTube and Google is like, I'm like, that's it. Okay, I'll buy it. Like,
no, and
I'm like, I don't think people realize how addictive YouTube is and how much they're going to be able to monetize that long term. And it's like it's free content. Like they don't have to publish or like work on any of this content. It's all free, like, to them. It's just almost reselling content.
Right. And yeah, they pay like a little bit out in ads, but in ad sharing. But like the thing is it's like there's no one to, Netflix still has to worry about HBO Max, Disney Channel, Amazon Prime, all these, like, the closest thing to YouTube is Rumble. I mean, so.
Ooh, okay. Here's a big bearish scenario potentially. Okay, let's because I like to be negative, you know. All right, so what if, and I think this could potentially happen. What if Mr. Beast says, "Hey, I'm off of YouTube. I'm Hulu exclusive."
Do you think that drives people off of YouTube, or do you think it just drives people to Hulu, but they still watch YouTube?
I think a little bit of both. Well, so I don't think it would drive as many people off of YouTube as you would think, but I think the market would shit a brick.
Yeah. Well, I think the bigger bear case would be instead of Hulu, it's I'm exclusive to Rumble.
Something.
But obviously in a real world though, Rumble wouldn't be able to deal with that. In fact, Mr. Beast even says like he doesn't even get paid out the full amount for his YouTube ads because basically he's at a point where what he cares about is max reach, and for his
product,
brand,
product marketing,
right. And
the only way it makes sense for him to go somewhere else is if one of these huge, like Disney or Netflix, could offer him just stupid amounts of money.
It'd have to be insane.
Yeah,
and his
like
his audience skews younger, right? Like he's got a very young skewed audience. Because the thing is, like,
it's probably a good mix, man. I don't know. His audience is like 2 billion people, so like it's everyone.
Shit,
dude, he gets like, gosh, go look at some of his videos on his main channel because he has like 12 channels. He has channels in like every single language.
I built 100 wells in Africa. Oh, I saw just someone on Twitter be like, "Capitalism is right." So like capitalism,
but like,
and go build wells in Africa.
Is like his videos get more views than the Super Bowl in like the first like 2 hours or something like that. Like the amount of views that he gets on his content is insane.
Yeah, I mean, like, and this is gonna be, I think, the last thing I'll say before I go. But I've seen it with Celsius, and I'll say it like Mr. Beast is. Just because you think a product or something isn't interesting or good doesn't mean that there isn't a market out there for it. Because I've watched his videos and I just think he's boring. That's just like my personal opinion. But also, like, I like looking at stocks, so like maybe I'm the boring one.
No, definitely. I mean, we're not exactly normal,
right? Exactly. So, but like, I'll watch his videos. And I'm like, people find this interesting. Like, I'll watch it for like 20 seconds. I'm like, okay, moving on. Same thing with like a Celsius. Yeah, Mr. Beast loves YouTube too much.
Yeah, I think you're right. He owes everything to YouTube, so he probably wouldn't. But I'm just saying, I was just thinking like larger creators. That one creator is going to Twitch, so it's just the start.
It says,
but
yeah, it's interesting. He was on Joe Rogan. Mr. Beast?
Mr. Beast probably. I don't know.
I don't follow he's on Joe Rogan. Someone offered him like $1 billion for his channel, but he just loves being on YouTube.
Yeah.
Well, I think the other thing too is like, where else would he go? And that keeps him being that. I don't think you have anywhere else where you have as big of a reach. Like, okay, so to your point, what's his 208 million subscribers? Insane.
Soon he will have more subscribers than the population of the US. Give him like a couple of years.
Dude,
yeah, he probably already actually does. If you count all of his channels, he's probably already close to that.
It's really funny. He like had a job posting. It was a big joke in the accounting subreddit because there's postings to like be an accountant for his company, and it was like, imagine like your boss coming in. It's like, yeah, I just gave away $2 million. Oh, like they were a receipt. No, I gave it all away in ones. It's like, how do we account for this?
What an like, what a nightmare.
And it even said like something like have to be comfortable with like creative accounting or something like that. And people were like, oh,
creative accounting, that just sounds like fraud.
Yeah, that's usually what that shorthand is for. Dan, no, I did not
Medium
apply.
accounting.
I should have just because you know what? He's actually based out of where I used to live, I think, because I used to live in Charlotte, North Carolina.
Oh yeah,
I think he's over there in like Winston-Salem.
I think he is too. Yeah.
Yeah.
Anyway, but I will say Google is one that I'm like, man, I'm when it dropped, I was like, I should just buy more. But it bounced back. But
Yeah.
I don't know. I'm really interested to see what. I feel like I'm getting ahead of myself. But I'm really interested to see what the markets do in 2024. Because usually we always have some type of a sector rotation somewhere. Like what's going to get cheap, what's going to go through momentum. Like, yeah,
Well,
I don't know.
I mean, not to pat my own back too hard, but I need some back patting after Paylocity. XLE is falling. I like ticked the top pretty well on that one. I wonder if energy goes down again to the mid to low 70s and then bounces back.
We can pat your back with Musa. Okay.
Well,
Look at that. Look at that.
Yeah.
That's crazy, man.
Yeah, I know we talk about
what?
This is another great example of like the stock will come to you.
Yep. I think most of my shares were in like 255 or something like that.
Yeah.
It's like, okay, cool. And then I had more loaded up for 220s. If it got there, I was like, that was like my like, oh, it's on. Like that was my area where I was like, let's go.
That's where you're like, okay. It's like, have older buildings burned down? No. Okay, let's just go.
Okay, we're good. Oh man. All right. I think we need to wrap it up. It's been about, oh my gosh, an hour 40, but it's been fun, man. It's been fun.
It has been fun. Thanks for having me.
We'll do it again. And next time I won't start until you're here. I promise. Okay. And then that way I won't have technical issues. So it was the curse of Andrew, man. I started and it was like, they're like, your screen's blank. I'm like, what? And then I'm like, oh, my camera's out. And then it wasn't my camera. It was just my screen share. So I like turned off my camera and then I was like,
I cursed you, man.
But
I did it.
Anyways, hope you guys are having a good one. And we will catch you hopefully next week.
That's good. See ya.